Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to start off today talking about the debt ceiling negotiations going on in Washington because that's the topic that has been all over the airwaves and on the televisions. And it's an important issue. Essentially, the Secretary of Treasury has come out and said that on June 1st, if the United States does not have its debt limit raised, which is a statutory limit to all of the issuing of new bills and bonds and notes that the government can do in order to fund itself, we're going to essentially run out of money to be able to pay our bills. And that statement's got some analysts and some television personalities nervous that there's going to be a sovereign default, and meaning that the United States would default on its debt payments. And we just don't see any meaningful probability of that happening at all. It's first of all in no one's interest to let that happen. The U.S. Debt is considered to be the quote unquote risk free asset in most financial models that are used to price securities. And therefore, if it was introduced that there was a risk of default in those securities, there would be widespread market impact. But we just don't see that happening. It would also cause potentially, the U.S. dollar to lose its status as the reserve currency, or at least some of the prestige. And they don't want that either. So what would more likely happen is the same playbook that happened the last time we had negotiations go this far, which was some time of a number of years ago, where they slowed down or stopped benefit payments to certain social programs, and they stopped paying federal employees salaries for a period while they continued to negotiate under increasing pressure that finally brought everyone together because they realized the importance of the situation, and their constituents were getting angry with them for dragging these talks on while people were not getting their pay. So we see that as a potential. And if that does happen, markets are likely to become more and more volatile while these talks work themselves out. But we don't see any meaningful probability of a default on the sovereign debt. Now, with that said, there are other important factors that are driving markets. And over the past several weeks, we've got a lot of economic data that came out that shows an economy that's stronger than what was expected, and inflationary pressure that's been stronger than expected. And because of that, the Federal Reserve is now considering, at least according to interest rate futures markets, a raise to the rate again of 25 basis points at the June meeting. A couple of weeks ago, this had about a zero probability indicated in those futures markets. Now it's closer to 40%. And if we continue to see inflationary pressure over the next couple of weeks, we're going to see that probability increase, and that would be a surprise. Markets had expected the Fed to be paused, and we're not really sure how this idea ever took root because we've never subscribed to it, but there was a perception prior to the past few weeks that there would be eventual rate cuts within 2023. That's something that we don't see happening at all. Now, over the next few weeks, the data that's key, sentiment indicators, real estate market indicators, we'll get the meeting minutes from the last Fed meeting, and that's key because they'll have discussed what they're looking at and pointed out the types of things they need to see in order to remain steady hand at the June meeting or potentially hike rates. And so we're going to be using that as context for all of this other information. Again, labor market, GDP information, price information, more real estate. Income and spending is big because that ties to inflation. Durable goods ties to the economy. Sentiment, we're going to get data that tells us whether the economy is more likely to continue to expand or contract. And when we get these non-farm productivity numbers, those if they start coming in stronger, that's a good thing. Not necessarily key to the inflation or recession theme, but it is important information to us. Looking at the jobless claims, if that continues to surprise in an upward fashion, to where they're creating more jobs and they're losing less jobs than what was expected, that indicates continued inflationary force. We want to look at the S&P 500 because looking at this, we've pulled out here 20 years. And as you can see, we've got some serious periods of decline throughout the whole 20-year period, including last year, which was in 2022, pretty much a bona fide bear market. And then now we're kind of trickling up. Over the long term, this market has produced pretty close to an 8% annualized return. And that's about normal for what we might expect. the past year has been just kind of sideways action between 4,200 on the top side and 3,500 on the downside, although most of the past year to date has been spent between 3,800 and 4,200 in the S&P 500. Recently, this is key. Despite some really bad news that's saying that, hey, inflation's a bigger problem than we expected, the market still remained really tight near the top of that range, and even looks like it's trying to poke out above where it's at, for the whole year, new highs. And with that happening, if it gets above that 4,200 level and stays there, which, it looks like it could do, that indicates a very bullish sentiment, because when the market cannot go down and there's news that's making it, quote unquote, should go down, well, then you've got a strong market. I mean, underlying, even if there's a weaker than expected economy, and even if there's a recession that's expected, markets are looking out 18 months plus in advance. And it appears to us that the market is starting to look toward a recovery. And maybe with all of the inflationary data that's come out and it's still able to rally, it's possible that the market participants have collectively adjusted to the idea that we're in an inflationary environment for the longer term. And as a result, we're now looking at different factors of what's going to make stock prices go up, and we're focused there instead of this bad news. We might see higher rates, and we don't want to ever see higher rates. The market appears to have adjusted to a higher rate environment, and that's really good from the sense of lowering volatility as we go forward. Looking at the Treasury curve, it's pretty heavily inverted. The difference between 10-year yield at 3.68% versus 2-year yield at 4.25, that is a pretty steep inversion of the yield curve that telegraphs that we have pretty high probability of recession. Again, in that context, the market is remaining very strong. And we're going to close things out with corporate debt, which rates are pretty decent. Yes, this is mildly inverted as well. 1-year paper's over 5%, 5-year paper's 4.61, 10-year paper's back to 5%. But the important point is, for income investors and those who are looking to diversify some of the equity volatility away from their portfolio, you're now getting income to compensate for that at meaningful levels. So this is a good environment for fixed income investors relative to the recent past, and this is a pretty good environment for stocks. So with that said, if you've got questions, if you've got concerns, we're here to talk. Hope you find this video useful. Thanks. Have a great day.